Hello, and welcome back to Global Perspectives in Climate Migration. Today's lecture takes us into the heart of the American climate economy. We're going to look at how risk, protection, and recovery are distributed unequally. As you know, in this course, we typically find some pattern of injustice, and we uncover that. The text through which we're going to view this is On the Move by Abram Lustgarten. This is one of the primary texts for the course. However, because it focuses primarily on migration within the United States and also migration from just South America to North America, it is going to be a bit of a limited use in terms of what we do, but it's perfect for this discussion. We're going to look at how climate change exposes the economic architecture of inequality. We're also going to discuss how insurance and policy decide who is protected and who is left behind. Throughout this module, you're going to see a little bit of it's not haphazard, I promise, but it's going to be a little bit maybe out of order. We might introduce the topic and then discuss it more in a following slide. So just trust, we're going to close all the loops, dot all the I's, and cross all the T's. But we might start with an unfamiliar term and then bring it back, through a better understanding in a later slide. Okay. So we're starting off this discussing the business of risk through a concept called moral hazard. Now, moral hazard exists in a bunch of different contexts, but for the purposes of insurance, it's when an insured person takes more risks because they are protected from the financial consequences. So this happens because the insurance company bears the cost of the loss. And this gives the policyholder an incentive to be less careful than they might be without that coverage. So a good example of that is this chart we have here, which discusses the demand for health care or healthcare services, units of medical care, whether someone has insurance, as denoted by this first line, or if they don't have insurance. If they do have insurance, by this top line, you see there is a constant shift, a significant constant shift based on the amount of insurance protection somebody has. What this basically tells you is that people will go to the doctor if they have health insurance. More. If they don't have health insurance, they're less likely to go to the doctor. And this is whether or not they have an ailment. Now, the thing about it is that sounds pretty common sense, but let's keep talking. A quote here from the author is, as private insurers flee from climate-exposed markets, the federal government increasingly steps in to absorb those losses, socializing the cost of risk while privatizing the profit. We've built a system that rewards staying put even when the ground beneath us is no longer safe. So now this is important to understand both of those concepts together because we're going to see exactly how this works now. In the case of the National Flood Insurance Program, now this is what we have to understand about the National Flood Insurance Program is that it was never really designed to protect people. It was designed to protect the housing market. So the author writes that that entire neighborhoods, especially along the Gulf Coast and Atlantic coast, have been rebuilt 3, 4, even 5 times using taxpayer money. This being a federal program that ultimately subsidizes insurance policies and claims. These homes sit directly in floodplains, but the subsidies keep them in the floodplains. And as we've discussed, sort of what happens after a disaster, the decisions to rebuild in certain areas that remain vulnerable ultimately create this increased propensity for this moral hazard. This map of Sacramento is significant because it really illuminates a concept called redlining. To one extent, you've got these literal red drawn lines over areas, right? That are here, and they're discussing what basically the redlining policies or of HOLC would traditionally label a group or a community as less desirable or less marketable. There's specific terms that we'll kind of discuss throughout this lecture. But this map specifically shows how the red lines of the redlining overlap with existing and known floodplains. Okay, so this is just one example of how sort of mortgage companies and different policymakers essentially form barriers around who gets to live where, who gets the support that they need, and who ends up being relegated to living in unsafe or dangerous environments. Um, the challenge with this type of issue goes beyond the sheer existence of floods, right? The eventual floods, or let's say the 100-year flood. You often hear that term. Um, we we know that this is just another reason to not offer further support in that type of community. And so we'll see just systemic neglect of certain communities. This slide discusses red and green. Okay, so I'm going to read you the redlining. This is really just understanding of what redlining is in very like concrete terms. Okay. So, redlining is the discriminatory practice of denying financial services like mortgages and insurance to residents of certain neighborhoods based on their race or ethnicity. This is key. This practice, which was once legal and widespread, involved lenders marking areas with significant minority populations as, air quotes, hazardous on maps, often in red, leading to a lack of investment and resources in those communities. Though outlawed, its legacy of creating disparities in wealth, health, and opportunity persists today. So imagine if you have a community that is, again, considered less worthy, it is relegated to flood prone areas and other vulnerable environmental hazards. There's going to be less investment in parks. There's going to be less investment in transit, less investment in business that's going to go into those areas. So ultimately, it's just going to become more desirable over time, and it's a mounting effect. Even the property owners of those communities are going to be left with less value accrual in their properties over generations, and that's going to have a systemic and long-term generational impact along racial lines. Now, greenlining, on the other hand, is sort of a counterpunch to that. Greenlining is a concept. It's the proactive process of directing profitable investments and resources into historically underserved communities to counteract systemic inequities. It is often framed as the opposite of redlining, which was the illegal practice of denying services like loans and insurance to certain neighborhoods, often based on race. Greenlining aims to foster equitable and sustainable community development by investing in housing, infrastructure, and economic opportunities. So, what we'll see as we continue on it's just that there is this sort of push and pull as we understand and grow and learn more about these um, negative challenges to equity. We're finding sort of solutions for those and workable solutions that could be implemented throughout the future for sustainable planning of cities. Okay, so now we're going to take a quick look at a case study. Um, Hurricane Ian is essentially the case study, but we're really only looking at the insurance in this case study. We see this spike here in insurance premiums from 2019, the year of Hurricane Ian, on doubling in 3 years. State-backed Citizens Insurance becomes the insurer of last resort. Tons of insurers exit the Florida market. Now, when you hear insurers exit the Florida market, that effectively means that you've got people who have been investing in insurance for their homes over a long period of time um, that are no longer able to purchase insurance from that insurer. And if you know anything about insurance premiums, they tend to be sort of grandfathered in to an extent. So if you have a policy, it's going to continue to go up, but it goes up at a certain rate. If you're essentially dropped because that insurer leaves, your insurance is kind of starting from zero, so you might have to just get something completely new. When entire markets collapse, the choices become impossible. You can't afford to stay, but you can't afford to leave either. This is how the climate migration begins, not with a flood, but with a notice from your insurance company. You will find, as we continue to study this topic, there are countless individuals who are choosing to leave states like Florida that are incredibly prone to disasters, but effectively cannot because, in addition to the fact that their insurance premiums are going up, making their housing unaffordable to them, it's also making it much less desired. It becomes a buyer's market, effectively, because now people don't want to buy it. They don't want to buy the properties because they're in floodplains and they're in the path of storms, but also they're uninsurable. They're too expensive to insure. And this is something that buyers do not want to be sacked with. So it's creating this unsustainable, this untenable thing that owners of these homes are effectively trapped in many cases. Um, Now let's talk about this federal policy and moral hazard. We brought up this term moral hazard before. Federal subsidies, like the flood insurance, they reinforce climate risk because they ultimately finance building in disaster zones through FEMA aid, flood insurance, and infrastructure replacement programs. And they don't really incentivize migration. So we're not taking advantage of managed retreat here. We're not really using funding as an incentive to relocate people. This is almost doing the opposite. It's again, it's almost like if you have a car and you continuously wreck your car, but every time you wreck your car, your insurance company is going to buy you a new car. You might not stop wrecking your car. You might not learn to drive better. You might not, get a bus pass. You might not take a driving course. It's just you have no reason to. You will continue to do the same behavior until you don't get an opportunity to continue, right? Um, the moral hazard deepens inequity. Subsidized homeowners in high risk zones receive repeated assistance, while renters and low income residents face disinvestment or displacement. So, again, we talked about this. We always see this and that vulnerability layer of renters or owners or income or education level. And it really is all connected into those same things. When you have to rent a place and it gets destroyed, you don't really get paid for what was either in the home or the home itself. You might not be considered in terms of temporary housing. You might not be considered in the ways that an owner would be considered. And so it's ultimately going to it gives those renters fewer options and less choices than people who own the properties, who are at least in a better decision making stance. Managed retreat remains politically untenable. And we talked about this before, about this sort of this attachment to place that cultures have. It becomes this thing that can't be enforced in with a real. It can't be strongly enforced because of cultural needs and the assessment that's needed for cultural preservation, and oftentimes. So it does require trust. It does require public discourse. Okay. So public policy privatizes benefit but socializes loss. And this is a very important factor. When we say privatizes benefit, it means that we're maintaining this illusion of resilience, but you're basically continuously funding owners through federal subsidies, which are funded through the public. So all people are putting into this flood insurance that's subsidizing people who are choosing to stay in Florida, but it's only going to this select few people, this list of owners in Florida who are making this choice. But essentially, it's affecting the rates and policies and expenses and contributions of people all over the country. We talked about sort of like when something happens in a major city, and they rebuild, they always go for a lot of money goes to those big infrastructure projects. It might go towards public transit. It might go towards roads, bridges, levees. It might go towards sanitation, like broader systems. But it doesn't necessarily trickle down evenly. And even the speed at which that money gets distributed is almost never even. It's almost never like equitable to like sort of that the lower income people. And so that's one issue of disasters and how like that federal money comes in. Um, when we talk about this, it's the same thing as the affluent neighborhoods get rebuilt faster and stronger. And a lot of that has to do with just political influence, political pull. If you have rich communities that have invested and been politically sort of funding sort of the mayors and the local people and like the local politicians and stuff, there's going to be more attention in those areas because of those relationships effectively. And so there's going to be a prioritization done there. And it's going to lead to a negative impact on lower income communities. Post-disaster recovery becomes a form of gentrification. And we see this over and over and over again. We're going to see this in the fires in California. We've talked about this in New Orleans as of our last one of our last previous lectures. Um, when places are wiped clean and like communities are wiped that are sort of again those previously red line communities, what often happens is because the infrastructure placement is not set back in those communities in enough time, people can't move back into those communities. So then they start getting, those properties can become seized if they're not maintained or if they're not meeting certain guidelines. So it really is a challenge for families who have to, who are in those lower income communities or those red line zones oftentimes. And so this is what leads to a broader wealth transfer. Okay. So governance and trust, and we're nearing the end of this, but that trust factor is massive when it comes to anything dealing with our topic of climate migration, justice in general. Governance sits at the heart of climate resilience, yet it's also where trust most often breaks down. So according to our author, the United States has built a disaster system that manages damage rather than prevents it, one that continually restores risk instead of transforming it. Communities learn over time that promises of safety are conditional, protection is delivered unevenly, aid is politicized, and transparency is rare. In many flood or fire-prone regions, residents no longer trust local or federal agencies to tell the truth about danger, let alone to act in their interest. So, like, this is just a recurring theme. I'm so grateful that we introduced the case study of Hurricane Katrina prior to this, because it really, again, continuously underscores all of these themes in one place. It is such an important case study, especially within the United States. So, this erosion of trust deepens the divide between citizens and institutions, making adaptation itself a social challenge rather than merely an engineering one. Effective governance is less about fortifying levees and expanding insurance than about rebuilding legitimacy. Ensuring that decision making is participatory, that risk communication is honest, and that the most vulnerable have a genuine voice in how and where resilience is built. And what's incredible is that this is exactly what the Global Perspectives in Climate Migration track of our VIP is doing. Whether it's from the resilience standpoint or the migration standpoint, this is exactly what we're all leaning towards to be a solution in fixing and figuring out. So we're going to continue on and we're going to look at environmental racism and climate policy. So historical policies created the modern geography of risk. We talked about the homeowners loan corporation, that's the HOLC, that really was responsible for this sort of generational theme of redlining. Okay, so the redlining we've discussed creates disparity from an environmental standpoint, but also from an economic standpoint based on race. We've got climate hazards that follow historical fault lines, whether they're actual fault lines or or floodplains, this is something that we kind of have, we know that these things will continue to happen in these geographical areas. And it doesn't mean it's going to be exclusive to those areas, but if they're already happening in one area, they tend to almost get worse over time as opposed to getting better, right? Adaptation efforts risk repeating those inequities. So we want to make sure that as governments get involved and as planning happens, there is community discourse and involvement so that we're preventing this continual trend. This framework reminds us that resilience is not just about infrastructure or technology, it's about justice, trust, and agency. It tells us that climate policy must be co-created, not imposed, that data funding and decision making must circulate with transparency and reciprocity. In short, it redefines resilience as relationship. And again, we're looking at sort of these needs, democratic autonomy, bottom up leadership. We need social justice and equity metrics. Going all the way through to the center, we need a focus on human nature and indigenous rights, planetary health and wealth, mutual solidarity and accountability. So we're looking at really all of these sort of tenets, the values around justice and equity within this space. And this is really communicating sort of a future forward, which is really why I'm glad we got to introduce this author today, because I think it's really more about solutions with this text. Takeaways for this lecture. Focus on climate risk, how it's not evenly distributed, and we knew this already, and it's also designed to be disruptive to certain communities. Sort of insurance and adaptation are actual mirrors of inequality. So if you look at that ownership versus renter spectrum, if you look at that private versus U.S. public taxpayer burden of the risks associated with maintaining, staying in place in certain flood prone or disaster prone areas, we're seeing that that is also an issue. We just looked at that justice-centered governance, and how there has to be a cooperation between whether it's government, whether it's businesses, whether it's citizens, that's renters, owners, all of these stakeholders within this community, within these broader communities, need to be at the table to find solutions that are going to be trustworthy and have merit within the space of what's being what challenges exist in this space. And lastly, there's gonna need to be imagination associated with these solutions. Redefining resilience means rewriting the rules of participation, finance, and accountability. From a bottom-up leadership to regenerative economies, climate adaptation must move from reactive crisis management to proactive systems repair rooted in equity and shared prosperity. Redefining resilience means rewriting the values of participation, finance, and accountability. From bottom up leadership to regenerative economies, climate adaptation must move from reactive crisis management to proactive systems repair rooted in equity and shared prosperity. So, with that, I want to thank you all again for joining for Global Perspectives in Climate Migration, and I will see you all on the next course.